What's up, guys? It's your boy Authentic FX here, back with your blueprint to success. This is episode 3 of our May 2023 premium mentorship program, Mastering the Arts of Smart Money Trading. Guys, I hope you've been enjoying the series thus far. And today's lesson is basically going to be more in depth on internal range liquidity and what is liquidity, guys. I hope you enjoy the video. Have your notepad out and pen ready because the journey starts now. So to get into it, identifying internal range liquidity, guys. Before we get into the topic, we need to understand what is liquidity. Liquidity refers to the degree to which the market or asset or security can be quickly bought or sold in the market without affecting the asset price. As smart money traders, we look to find areas in the market where we can identify high probability liquidity pools that are resting in the marketplace. In simple terms, guys, this basically means buy and sell orders. So for this example, we're going to be breaking down this entire chart that we have here on USD JPY. This is obviously on the 4-hour time frame. So let's get into it, guys. So prior from our lessons of elements to a trade setup and then following through to the essentials of marking up the weekly and daily range, we have gathered the information and elements that we need to find certain trade setups. So right now, as you can see from this price range that we have from this new high to this new low, we are currently in a discounted zone, right? So what we look for when it comes to liquidity pools and liquidity voids is basically to identify where the market liquidity or buy stops and sell stops are resting, guys. As I said before in the prior video, we need to think like market makers, right? So as you can see from this price leg going to the downside, we've reached our discounted zone, but notice how that all these areas at these highs are left untouched, basically. So price hasn't pushed up to the upside yet. So basically what rests above these areas is buy stops, and these are basically orders or stop losses of certain individuals or traders that have placed stop loss on these moves down, right? So notice the people who have bought price from this low to this high, price has then taken them out, right? So those who were in for buys and had their stop loss at these lows have been taken out. Those who were in for buys, their stop losses have been taken out. So now that the ones who were in buys, stop losses have been taken out, we are now looking to take out the highs of those who are in the sell positions, right? So basically, we are in our discounted zone. The aim is to get above our equilibrium point, which is our midpoint on our fib level, which is the 50% level, and get in a premium level where we can start looking for sells. So we've marked up our draws of liquidity, which I did explain in the previous video and go into depth in that. And now we can clearly see that our target is from this void that we have, which is our fair value gap slash imbalance, and this high. We're looking to take out this high and mitigate this imbalance, and then from there come into our supply zone, which created this move, or you can say displacement to the downside, guys. So to get into it, the process is as follows, right? So we've marked up our areas of interest. What we then want to do is see a break of our first high, right? Look for that first break of structure to the highs and let price clearly push up with that, you know, push to the upside to show us strength or show us a reversal, right? We already have a sub break of structure with large bullish candles to the upside and a clear break to the highs, taking out this high. So what we then do now is mark up the order block and wait for price to come down, mitigate our demand zone slash order block, and obviously we have our targets laced up or put into our chart into our chart. So once price mitigates our demand zone slash order block, which is our last down candle before the major move to the upside, we then also need to mark up this high. Why do we need to mark up this high? Because as you can see that this high and this high are equal highs, right? So the aim is we are targeting first as TP1, we are targeting these highs because these highs are going to be taken out because that's our draw of liquidity. Notice on this candle to the downside, we have a void in the market causing imbalance. So this area obviously is going to be attracted, right? The market will automatically be attracted to this area, and there will be a minor reaction before we take out these two highs. Notice that this candle's main purpose was to take out these equal lows at the bottom here and then mitigate our order block. So once we enter at the high of the wick of this candle and have our stop loss just below these candles, right, we target our draw of liquidity. So TP1 will be or our points of interest will to be mitigating this void, take out these equal highs, and then target the secondary highs here, and then mitigate or fill the void within price on this fair value gap. Hopefully we are going to expect a reaction, which we can obviously be cautious about and just decide to take a sell from that position. If price does not give us that and decides to go up further and take out this high, then we will let price do so, guys. So what happens then now, as you can see, from mitigating our demand zone slash order block, price quickly rallies to the top, taking out that previous high that we marked up here. We can clearly see that now we've taken out that high, we've broken structure with the clean break of structure, created a new higher high. So from creating this lower high, lower low, we've created a high, a low, a higher high. So now what we do is we mark up this order block, right? So from this break of structure, we have created a new order block, which we do mark up, and then this order block should be responsible for creating the new higher low, guys. And our targets will remain the same. Can you see that we filled the void in this candle? Price clearly came in, reacted, and then pushed up to the upside, creating this new high. And then from there, we have mitigated now this new order block that we have formed, because this order block is responsible for the bullish momentum or push to the upside to take out this previous high, and also this high to the left that we have here. Right now, clearly we have filled the void within this candle and this candle, so there is nothing left to look forward to, guys. So notice how when price retraces here, right, and then retraces up to the upside, creating that minor microstructure expansion, we then quickly rally to the downside. Why do we do that? Because obviously to the left of us we have a fair value gap between this area, which price is basically mitigating and respecting. So obviously if you were to scalp, you could scalp this minor microstructure sell into the order block, and then from there continue the buy to the upside. But obviously we are not looking at that right now. We will have a video explaining how to basically scalp and use these smaller time frames to catch big moves on the micro time frames. So anyway, once we've mitigated our order block, we can clearly see our entry point will be obviously at a reaction. So once we see this candle push up with bullish momentum, creating that bearish inside pin bar, this bullish candle will be our entry point, and our stop loss will just be below this order block. For those who want to be safe, you can put it below this wick or this wick here. And then now where our targets. Remember, we're still in position one. So position one is still running. Obviously, position one, our stop loss will be taken to the entry points, right? And then position two will be our secondary entry. And then notice how once price mitigates this order block, we do not come back down all the way to position one, right? We respect the order block, price breaks out with a large body candle, which is bullish, showing momentum, right? This momentum actually takes out the high, right? It takes out the high that we've targeted. And notice that we are also targeting this high and this imbalance or void in the market. Look at how we take out this high with large body candles, right? Look at the bearish candles, how small they are. This shows us that the market is actually in a position of drawing to liquidity, and where that liquidity is at these highs after taking out all the sell stop, the buy stops, and filling the void in the market, guys. So from taking out the highs, at these levels, we can see now that we've created equal highs here, and then we mark up that high because that will be our next target. So we mark up our areas of interest, which is what we learned in the first video, which is our institutional patterns that create trend setups, right? So we can clearly see we've left the void within this candle, which is our fair value gap. Notice how when price gravitates back to this fair value gap, we have a reaction to the upside. So basically a spike to the downside, and these candles are closing in an upside momentum. And usually when we see candles closing in this manner, it shows us that price does not want to go down. Price is reacting and price wants to go up. So within lower time frames, as I did say, this is the 4 hour. Usually, what we see is people in lower time frames are trying to sell price because they see this break of structure, but they do not understand that the main objective of price is to fill this void and take out this high and eventually gravitate to the supply zone that created this displacement to the downside, guys. So what we are going to do is stick to our plan till we see a confirmation within our points of interest, guys. So as we do, we mark up the high, we wait for the reaction, which we clearly got, and then we enter for a entry point at the high of this candle, and our stop loss just below the candle that created that fair value gap. Look at how price gravitates quickly to the upside, creating that push, guys. Breaking structure, taking out both these equal highs, mitigating price at this level, which basically means that now the banks have basically closed their orders, right? Since they were in a sell position, they've basically mitigated or closed their sell orders and have opened buy orders. But within this move going to the downside, they have also opened sell orders, which they are gonna gravitate to or revisit, right? We are going to get into the details as we go through module 4, which will be tomorrow, guys. But look at how we perfectly take out these highs and get all the way into our points of interest, which is our supply zone. So just imagine entering on this trade and you have a risk to reward ratio from this one of 1 to 3, this one of 1 to 5, and this one 1 to 8. And basically you clock in about 100 pips here, 80 pips here, and basically 50 pips on this trade. If each trade has not hit our stop loss, because we know where to put our stop loss, guys. It's very important to know where to put your stop loss, because if you were to put your stop loss below this area, you would have been taken out by these spikes. So what is the next step? Internal range liquidity and market structure shifts. So for us to put into perspective market structure, we need to now identify the minor points of interest. So within internal range liquidity and market structure, we have the following. Once the market takes out an old low, right? Old low or old high, right? Identify clean areas of sell stops or buy stops or equal highs and equal lows. It's most likely that price will sweep those areas, right? So we've got our range. We can clearly see that we've built equal highs, equal lows, equal highs, equal lows, equal highs, not equal highs, sorry, new highs and new lows. Basically, residing at these highs is buy stops, residing at the lows is sell stops. Notice once price gravitates and take out all the buy stops, takes out the buy stop at that range, gravitates to the downside to take out these sell stops, right? And equal lows. That is the principle, right? So once we mark up buy stops or sell stops, that will be swept on the daily time frame or intraday time frame, such as the 4 hour, 1 hour. You see this on all different type of time frames, guys. You then anticipate sell or buy side liquidity to be taken out. Stops will be rallied, then further causing displacement. Displacement is basically that after a price has swept liquidity, quick move to the downside, breaking structure to continue a new trend or create a new trading range, right? So basically, apologies for the glitch there, guys. So basically, as I was saying, a bullish break or bearish break of market structure must occur once price has taken out an old low or old high. So notice how we've taken out these highs, right? A displacement to the downside must occur, breaking structure, right? And then from there, once price breaks structure to the downside, we will obviously zone out this new trading range, right? Within this trading range, we will note that there will be a fair value gap or void in the market, which will usually be between the equilibrium points of the entire range that price was targeting to take out, right? So what we are basically anticipating is an expansion to the downside once price enters this imbalance or fair value gap. And then now from targeting the buy stops, we will then target the sell stops, vice versa with a buy side module or diagram, right? Basically, what is occurring right now is price pushing to the upside, creating a nice price leg. We then have a nice push to the downside, which basically price will be targeting the low of this range, right, to take out the sell stops that reside. Once these sell stops are taken out, we will then target buy stops to the upside, which will then see price gravitate to the upside, breaking structure, coming down, filling a void or imbalance or even an order block, guys. These are one of our institutional patterns that we use, and then a further expansion into a premium area to take out price. So basically, always identify if you are in a premium or discounted level or an equilibrium within a trading range so that you can understand when it is the right time to sell or buy, or when price is overbought or oversold, guys. So the definition of a premium level is when price is overbought, and a discounted level is when price is oversold. That is followed by the equilibrium, which is basically the 50% mark of the entire range, right? And then from there, we then mark up a new area of we basically mark up our new zone once price gets out of this trading range. Once price reaches this level or trades below, the algorithm will continue its bullish or bearish run at the equilibrium depending on the current trend. So what that basically means is, since we've marked up this range or price leg, we have our premium, discounted, and equilibrium level here. Once price takes out, for example, a discounted level, that is inducing shorts, right? So the market wants people to sell, right? Because they are mitigating the bullish price action that they have implemented. So they are mitigating, they want people to sell the market, and they want to close also buy orders that they have opened in this price leg. Once they take out this low, they will then induce buys, right? So price will have a quick reaction. So the algorithm will basically push price to the upside, and then from there to continue a current bullish trend, which it stems from this first leg. Now this will become our second leg from this high till that low. So it's basically price creating a low, a high, and then from there expanding to the upside. Displacement is caused when an impulsive price move occurs or impulsive price swings. This is caused by the algorithm to drive price higher or lower. So guys, since now, let's go back to the old example. We have taken out our buy stops, right? So currently we are looking at the diagram over here within this move. We are currently in a nice supply zone. So where is our next target? Since we've taken out all the buy stops, right? You can clearly see that we've had 3 consecutive highs. And also, guys, I want you guys to put this down in your notes. Whenever you have 3 consecutive highs, right? As you can see from my diagram, we've had 1, 2, 3, 3 consecutive highs. Our next price leg will be a reversal. As you can see, we've had 1, 2, 3, 3 consecutive lows. Our next price will be a reversal. Once we have these 3 price points or consecutive highs or lows, price will reach its area of interest, mitigating to the left all the buy stops. And then now, once we've entered our supply zone, the next thing we need to do now is say, where is our next target? Our next target will obviously be the sell stops that reside at these lows, because once people are buying, they're holding their buy positions, right? As we were doing in the previous slide here, we were holding our buy, we entered here for buy, so we were having our stop loss at the low, which we were holding our orders, right? All the way till price got to our points of interest. So those people who do not close their entries leave their money resting at these lows. The market will then mitigate or reach its points of interest and then now gravitate to the downside to take out the orders that are resting at these lows, guys. So that is the lesson for today on internal range liquidity, guys. Just know, remember what we said in episode 1: what goes up must come down, and what goes down must come up, guys. That is trading, guys. So that is the lesson for today. I know it's very short and brief, but I hope you understand. Please don't forget to drop a comment and tell us how you're feeling so far about the mentorship program. Drop a like, share. Please don't forget to subscribe, guys. And please, guys, be tuned in for tomorrow's lesson, which will be more in depth following the previous episodes. I want to leave you guys with a quote from today from Peter. Basically, the quote goes as follows: life is a journey, and if you fall in love with the journey, you will be in love forever, guys. So that is the quote for the day, guys. I want you guys to fall in love with trading. Know that this thing, if you put in work and grind and back test and put in the effort to basically learn, go back to your charts, read your notes, and go through everything step by step, you will understand the diversity of the market, and you will know how to trade, and you will be successful and profitable long term, guys. I hope you enjoyed the lesson. This is episode 3 of Mastering Smart Money Trading. I will see you guys tomorrow for episode 4. That is a wrap, guys.